The intelligent investing is to buy what you know. In this session, I will provide overview of framework to develop reasonable understanding of business that you are planning to invest. We call it as moat. The concept of economic moat is originated by legendary investor Warren Buffett. It is his idea of castle surrounded by water that protect the castle from outsiders. He further mentions that it's even greater advantage to have sharks and crocodiles in the water. With that kind of moat, it's almost impossible for invaders to break into the castle. Let's apply this analogy to the business analysis for stock investing. Think of a business you are planning to invest as castle. Then you should ask, what is an economic moat? Moat refers to the ability of business to keep its competitor away from taking market share and grow over a long period of time. As a consumer of products or services, you will be willing to pay lowest prices. This means, business will shift to the companies that are selling similar products or services at a price cheaper than competitors with reasonable quality. However, that is not always the case. Think about why people still buy iPhone, when there are substitutes available at much cheaper prices. This means, such companies have some kind of a moat. Moat is really the competitive advantage that allow companies survive and grow over a long period of time. As an investor, you should be able to identify companies having moat and stay invested over longer period, taking advantage of compounding machine. The question is how average investors should identify such moat. Let's try to understand what makes a moat and how to perform business moat analysis. Within 3M investing framework, the first M stands for moat. It focuses on identifying a company within a sector you understand or capable of understanding and creating your investment story. You probably would be thinking what level of business understanding individual should have to minimize the risk in investing. Well, there is a process to develop a business understanding that can be understood by anyone. Let's get into the high-level details first. We classify moat analysis into 3 broader categories. First, define your business along 5 parameters. We gather information from various sources to analyze company along 5 parameters, namely product, customer, form, geography and growth. For example, when it comes to product, you should be able to understand, are companies' products being goods or services? How do they make money? Are these revenues recurring? Is it a fast-changing industry or product? Is it a cyclical business? These questions will help you to develop good understanding of business. The second part of business analysis is moat classification. As per Michael Porter, there are 5 influencing forces for market position of a business. We perform competitive position analysis by addressing 5 forces that act on every business. These 5 forces are threat of potential new entrants, threat of substitute, bargaining power of supplier, bargaining power of buyer, intensity of competitive rivalry. After this, based on the business analysis, we try to identify the business moat. There are 7 types of moat you can look for, namely brand or intangible assets, pricing power, secret, which is essentially patents, trademark, or unique offering, monopoly, switching cost, and network. Business can have one or more than one moat or no moat at all. Lastly, confirm existence of moat through financial statements analysis. If business passes along 5 vital parameters, holds competitive position in the market and has at least one of the moats, this will certainly show up in the key financial metrics. We expect companies with deep moat will have compounded annual growth rate of minimum 10% across various key financial metrics like sales or revenue, net profit or EPS, free cash flow and overall book value of the business. These numbers are the proof of existence of a strong business moat. The business has moat when it's hard for competitors to get into and be successful. For example, Pidilite Industry has Fevical as one of its products, capturing 70% of the market share. It has been hard for competitors to replicate the formula and develop brand value. Companies that can get their products to customers at a lower price than the competitors have a competitive advantage over similar businesses. Moat is a good example for pricing power. As the company expands into a larger entity, it will be capable of purchasing larger orders to lower costs and gain more profits. Another example could be Facebook. It has network advantage where users can stay connected through its various products like Facebook and WhatsApp. It's hard for other companies to build that kind of user base and network effect. If you cannot spot growing key financial metrics, you are on the thin ice of hope and trying to predict the future. You should never buy a business if there is no existence of moat through financial statements analysis. Thank you.